Want to beat the market in 2026? Skip the hype and focus on 3 brilliant growth companies quietly reshaping entire industries. Today, I'll break down 3 tech stocks I believe are set to crush the market by 2026. We'll cover a company revolutionizing restaurants, a tech-driven beverage brand, and a data titan powering the internet and AI. These aren't random picks, they're strategic bets on the future of how we live, work, and spend. Stick around for a deep dive into why these 3 are on my radar for massive outperformance. Smash that like button and subscribe so you never miss a market-beating idea. Let's jump into the first stock that could be a huge winner for your portfolio. First up is Toast, ticker TOST, a company quietly transforming the restaurant industry from the inside out. While it may not be a household name for everyone, Toast is rapidly becoming the backbone of modern dining, powering everything from your local cafe to bustling city bistros. If you've dined out recently, there's a good chance you've interacted with Toast's technology, maybe without even realizing it. Whether you tapped your card at the table or ordered takeout online, Toast was likely working behind the scenes to make your experience seamless. For years, restaurants have struggled with a patchwork of clunky, disconnected systems, old-school cash registers, paper tickets, and endless spreadsheets for sales, payroll, and inventory. This chaos made it hard to keep up with the fast pace of the food industry. Toast changed the game by introducing an all-in-one platform designed specifically for the unique needs of restaurants. No more juggling multiple vendors or wrestling with incompatible hardware. Toast brings everything together in one intuitive system. Their hardware lineup is impressive: sleek POS terminals at the counter, handheld devices for servers to take orders and payments tableside, and digital kitchen displays that keep the back of house running smoothly. This tech not only streamlines orders, but also slashes errors and wait times. But the real magic happens in the software. Toast operates on a software as a service, or SaaS model, meaning restaurants subscribe to a suite of powerful tools that are always up to date, always improving, and accessible from anywhere. Toast's platform covers every angle: online ordering, delivery integration, loyalty programs, targeted marketing, payroll, scheduling, and inventory management, all from a single dashboard. It's a digital command center for running a restaurant in the 21st century. Owners and managers get access to real-time analytics, allowing them to optimize menus, adjust staffing on the fly, and boost profitability. With data at their fingertips, they can make smarter decisions faster than ever before. This level of insight was once reserved for massive chains with deep pockets. Now, even the smallest neighborhood diner or family-run cafe can harness the power of data to compete and thrive. Toast isn't just selling technology, they're offering a complete business transformation. Restaurants that adopt Toast often see smoother workflows, happier staff, and more satisfied customers. Their revenue model is robust and diversified. Toast makes money from hardware sales, sticky software subscriptions, and payment processing fees every time a customer pays their bill. Once a restaurant is up and running on Toast, switching to another system is a major hassle. That means Toast's revenue is not just recurring, it's highly reliable, creating a strong foundation for long-term growth. Toast has also expanded into financial services with Toast Capital, offering loans to restaurants based on real-time sales data. This is a smart, low-risk way to deepen customer relationships and help restaurants grow while generating additional revenue for Toast. The US alone is home to hundreds of thousands of restaurants. From food trucks to fine dining, Toast has only scratched the surface of this massive market, and there's still enormous room to grow. As more restaurants join the Toast ecosystem, the platform becomes the industry standard. This creates a powerful network effect, making Toast even more valuable to new and existing customers. Employees who learn Toast at one job can easily transition to another restaurant using the same system. This familiarity makes Toast even stickier and more indispensable for the industry. Since its IPO, Toast stock has seen its share of ups and downs. That's par for the course with high-growth tech companies, especially those disrupting traditional industries. The opportunity here is clear. Toast is a leader in a massive, fragmented market, with multiple revenue streams and a product that customers find hard to leave behind. Financials show strong top-line growth, a steady increase in average revenue per user, and expanding gross margins as the business scales. Toast is investing heavily to capture market share now, but as they grow, operating leverage will kick in, meaning profits should accelerate as fixed costs are spread over more customers. High-margin software subscriptions and payment processing fees will increasingly flow to the bottom line, driving profitability as Toast matures. Upselling existing customers on new modules, like advanced analytics, marketing tools, or payroll, continues to boost revenue per restaurant. That's a healthy sign for any SaaS business, and it shows Toast's potential for long-term expansion. Of course, competition is fierce. Square and Clover are big players in the POS space, but Toast's laser focus on restaurants gives it a unique edge. They're not trying to be everything to everyone. They're building the best possible solution for food service. Every feature, every update, every piece of hardware is purpose-built for the realities of running a restaurant, not a generic solution retrofitted for food service. The main risk? The health of the restaurant industry itself, which can be cyclical and vulnerable to economic downturns, labor shortages, or changing consumer habits. But here's the thing, Toast's platform actually helps restaurants become more resilient and efficient, giving them the tools to weather tough times and bounce back stronger. When you look at Toast, you are seeing a company that is already operating at meaningful scale, with a market cap of $19.99 billion. In 2024, Toast delivered $4.96 billion in revenue and posted $19 million in net income, translating to an EPS of $0.44. The valuation reflects a growth profile investors are still paying up for, with a P/E ratio of 77.3. By 2026, I see Toast with a much larger footprint, likely profitable and valued for its future earnings, not just its past losses. The company's growth trajectory is just getting started. The market is still underestimating Toast's potential. As the company continues to execute, expand, and innovate, its true value will become more apparent to investors and industry insiders alike. Getting in now, while there's still uncertainty and volatility, is how you position yourself for market-beating returns in the years ahead. This isn't a get-rich-quick play, it's a long-term bet on the digital transformation of a massive, essential industry. The way we dine out is changing and Toast is leading the charge. Keep Toast on your watch list and watch closely as the future of dining goes digital. Next, let's talk about Dutch Bros, ticker BROS, a coffee chain with a cult following and a tech-driven growth engine. Founded in Oregon in 1992, Dutch Bros has grown from a single pushcart to a nationwide phenomenon, all while keeping its energetic, community-focused vibe at the heart of its business. Dutch Bros isn't just a coffee company, it's a tech-enabled retail machine. Every cup of coffee is backed by a sophisticated digital infrastructure that's designed to make the customer experience seamless, fast, and fun. Their drive-through model is built for speed, efficiency, and a unique customer experience. Unlike traditional coffee shops, Dutch Bros focuses on getting you your drink quickly with a smile, and often with a bit of friendly banter that keeps customers coming back. The Dutch Pass app is central to their strategy. Customers pay, earn points, and get personalized offers, while Dutch Bros collects valuable data. This app isn't just a payment tool, it's a direct line to each customer's preferences and habits. This data powers targeted marketing, driving traffic, and building loyalty. Dutch Bros can send out custom deals, birthday rewards, and even limited-time offers that feel personal, making every visit feel special. It's a digital punch card on steroids, making it hard for customers to switch. The more you visit, the more you earn, and the more you feel like part of the Dutch Bros family. Technology also fuels their rapid expansion. Dutch Bros isn't just opening stores at random, they're using data to make smart strategic decisions about where to grow next. Dutch Bros uses data to pick new locations, analyze traffic, and optimize store openings. They look at everything from local demographics to traffic patterns, ensuring each new shop has the best chance to thrive. Inside, tech ensures consistency. Inventory systems reorder supplies, and digital aids standardize drink making. This means your favorite drink tastes the same whether you're in Oregon or Texas. Their franchise model, now shifting to company-owned stores, keeps culture strong and operations tight. By bringing more stores under direct control, Dutch Bros can maintain its high standards and unique culture as it scales. The small drive-through only format means lower costs and quick profitability. These compact shops require less real estate and fewer employees, making them nimble and efficient. Profitable stores fund more openings, creating a self-sustaining growth engine. Each successful location helps fuel the next wave of expansion, compounding growth year after year. Dutch Bros targets suburban and rural markets, reaching a younger demographic and expanding the coffee market beyond Starbucks' core. By focusing on these underserved areas, they're building a loyal following where competition is lighter. Financially, revenue growth is stellar, driven by new stores and strong same-store sales. The company's ability to consistently grow sales at existing locations is a testament to its brand power and operational excellence. The stock's been volatile, but the market hasn't fully priced in the tech component. Investors often overlook just how much technology is driving Dutch Bros' success and future potential. By 2026, Dutch Bros aims for 4,000 locations. Currently, they're not even a quarter of the way there. That leaves a huge runway for growth, with plenty of untapped markets still ahead. The runway for growth is massive, and their tech-enabled model makes it achievable. With each new store, their data advantage grows, making future expansion even smarter and more efficient. As they scale, margins should improve, better purchasing power, and more efficient marketing. Technology helps them optimize every part of the business, from supply chain to customer engagement. The biggest risk is execution. Can they maintain culture and service as they grow? Rapid expansion can strain even the best systems, and keeping that signature Dutch Bros energy is crucial. Their focus on promoting from within helps mitigate this. By investing in their people and developing leaders from the ground up, Dutch Bros keeps its culture alive and thriving. Competition is fierce, but Dutch Bros' drive-through focus and energetic brand give it a defensible moat. Their loyal customer base and unique experience set them apart in a crowded market. The company carries a market cap of $10.23 billion, with 2024 revenue of $1.28 billion and net income of $35.25 million. Earnings per share came in at $0.49, but the P/E ratio sits at 126.94, which tells you the market is baking in a lot of future expansion and execution. You're not buying Dutch Bros for today's earnings, you're buying its future growth as it scales. The real value lies in what this company could become over the next decade. If they execute, the market will reward that growth with a higher stock price. Investors who see the long-term vision could be well rewarded as Dutch Bros continues to expand. Dutch Bros is a simple story, beloved brand, profitable model, massive market, and tech as the secret sauce. It's a rare combination that's hard to replicate, and it's fueling one of the most exciting growth stories in retail. By 2026, expect a much larger, more profitable company, and a stock you'll want in your portfolio. Dutch Bros is brewing up a future where technology and coffee go hand in hand, and the best days are still ahead. Finally, let's talk about Alphabet, ticker GOOGL, the tech titan behind Google, and a company that has fundamentally shaped the way we live, work, and connect online. Alphabet is far more than just a search engine. It's a global data and artificial intelligence powerhouse, with its influence reaching into nearly every corner of the digital world. Google Search and YouTube are the undisputed leaders in digital advertising, generating massive revenue as ad dollars continue to shift from traditional media to online platforms. These platforms are not just popular, they're essential tools for billions of people every day. But the real growth engine for Alphabet is Google Cloud and its rapidly advancing artificial intelligence capabilities. This is where the company is investing heavily for the future. Google Cloud, which was once a distant third in the cloud race, is now growing at an impressive pace and has finally reached profitability, a major milestone that signals its arrival as a serious contender. As more businesses migrate their operations to the cloud, Google's deep expertise in data management and artificial intelligence gives it a unique competitive edge. Companies are increasingly relying on Google's tools to analyze data, automate processes, and unlock new insights. Alphabet has been an AI pioneer for over a decade. Its technology doesn't just power search and YouTube, but also drives efficiency in its massive data centers, making them some of the most advanced in the world. With the rise of generative AI, Alphabet is positioned to create entirely new products and supercharge existing ones, from smarter search results to creative tools that help users and businesses alike. Imagine a future where Google Search becomes a true conversational assistant, or where AI seamlessly writes your emails, builds presentations, and automates tasks in Google Workspace. This is quickly becoming reality. Beyond software, Alphabet is betting big on the future of transportation with Waymo, its self-driving car division. This is a long-term play that could redefine how we move through cities. If Waymo's technology succeeds at scale, it could become a multi-billion-dollar business in its own right, opening up new revenue streams far beyond advertising and cloud. Alphabet's other bets portfolio includes ambitious moonshots in life sciences like Verily and smart home technology, like Nest and Wing. These are high-risk ventures, but even a single breakthrough could deliver massive returns. Financially, Alphabet is a fortress. It boasts a rock-solid balance sheet, enormous cash reserves, and a history of aggressive share buybacks that reward long-term investors. The combination of steady growth from digital ads and the accelerating momentum in cloud services creates a resilient, powerful financial profile that few companies can match. Even after a strong run in the stock market, Alphabet still trades at a reasonable valuation compared to other tech giants, making it attractive for investors seeking both growth and stability. The market sometimes worries about short-term issues like advertising slowdowns or rising competition in AI, but these concerns are usually just temporary blips in a much larger growth story. Alphabet remains a financial powerhouse with a market cap of $3.81 trillion. In 2024, Alphabet generated $350 billion in revenue and produced $100.11 billion in net income, with EPS of $10.14. Even at that scale, it trades at a P/E ratio of 31.05, showing investors are still willing to pay a premium for durable profitability, dominant platforms, and long-term growth levers. The long-term trend is undeniable. The world is becoming more digital, more connected, and increasingly AI-driven. Alphabet sits right at the center of this transformation, shaping the future of technology. The main risk on the horizon is regulation. Antitrust scrutiny is real and ongoing, but Alphabet has a long track record of navigating these challenges and adapting to new rules. Innovation risk is always present in tech, but Alphabet's relentless investment in research and development and its culture of disruption make it far more likely to lead the next wave than to fall behind. By 2026, expect Google Cloud to be a much larger force, AI to be deeply woven into every Alphabet product, and Waymo to be on the verge of a commercial breakthrough in autonomous vehicles. Investing in 𝗗𝗟𝗨𝗦 is essentially a bet on the backbone of the digital economy, a company that powers the infrastructure, intelligence, and innovation behind the internet. For a company of this scale, the potential to outperform the market is still very real, especially as new technologies and business models emerge. Alphabet remains a foundational tech holding with a proven track record, unmatched resources, and plenty of growth ahead as it continues to shape the digital future. There you have it, 3 tech stocks with the potential to outperform by 2026. Toast is digitizing restaurants, 𝗗𝗟𝗨𝗦𝗧 is scaling with tech, and Alphabet is leading in AI and data. Each has a strong story, a competitive edge, and a clear path to value creation. The key to investing? Spotting these trends before the crowd. Want more in-depth analysis and exclusive stock tips? Join the StocksGalore Patreon, link in the description. It's the best way to support the channel and get even more value. Of the 3 trends, restaurant digitization, tech-enabled brand expansion, or AI dominance, which do you think has the most explosive potential? Let me know in the comments. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one. Stay smart, stay invested.